Hello, welcome back everyone to the Kushner Law Offices video blog. Hopefully, the materials help you so far at least get some better understanding of the law as it applies to your new or growing business, or maybe you were thinking about starting a business and didn't know the first thing of what to do. We're trying to help you here. And this video should help even more people that are looking to raise money, be it from a venture capital firm, an angel investor, a rich aunt and uncle, or whatever it is. When you're raising money in any way, shape, or form, you're selling a security. A security can be an LLC membership unit. It could be a limited partnership unit if you have an LP, a limited partnership. It could be stock in your corporation, or even if someone's promising on a debt, a promissory note, you're promising to pay them back on a loan. That's still a security. And the whole point of securities law is to ensure that when you're selling these securities, that you're being honest and that you're not getting someone else's money by giving them false or misleading statements. And there's been numerous litigation and convictions for people who have gotten large sums of money in support of their businesses by being untruthful, deceptive, and that's how the body of law has developed around this area. Now, you may be thinking, well, I already raised 50,000 from my partner and I didn't give two pieces of crap about securities laws. And okay, that's fine. Maybe nothing has gone wrong yet, and it's relatively small amount of money, because if you think about the cost that your partner may have to pursue to fight you, if he found out that, say, your business was going to do XYZ and they didn't do it at all, it may cost him over 70 to 80,000 just to fight you, well beyond his initial investment. So it's a sunk cost. So you sort of get away with it, for lack of a better way of describing it. But if you're raising a lot more money, you really want to be careful that what you're communicating, especially in writing, what you're communicating to your investor is truthful, honest, and that they're being apprised of all the risks, not just the rewards, but the risks inherent in the investment. So usually I would say the benchmark is around $250,000. It could be south of that. Whenever it's six figures, you want to consider delivering to your investors what's called a PPM, or private placement memorandum. And what that is, it's a long 60 to 80 page document, depending on how complex your business is, that just breaks down, look, this is what my business does. These are the people involved. This is what you get if you invest in it. This is what people already have. This is what we're making if you give us this money. This is what we're going to do with it. And also, there's about 20 to 30 what we call risk factors, which are like red line items, like if something goes wrong, this is what will go wrong. And it sort of tells all the investors before they invest, look, other people have done this and this is the risks they ran into, or this is the risks we're likely to face heading into this industry. So this is important, and it might a lot of my clients who I've prepared these PPMs for, they hate this because they think they're scaring away investors. But the PPM is not meant as a sales documentation. It's meant to protect you if in the future the investor does, provide the capital, and then they try to sue you because the business doesn't do well. You're protected so long as you provide as evidence this document that says, well, we apprise the investor of all the risks and they voluntarily assume those risks. That's the value of the PPM. Whether you're a production company that's developing a slate of films and you're trying to communicate to the investor what films you'll be developing, what projects you'll be putting the money into, or one of my clients is doing a virtual golf experience, and their PPM is telling the locations and the costs of development in all the areas, and it gives a market assessment of the potential consumers of this product in the area. as well as the potential risk with the profound competition in those areas. Either way, they're protected so that any lawsuit after the investor invests, having signed this PPM, the investor is going to lose, um, because they were apprised of the risks. And that's what you're trying to do here, is safeguard against future litigation by making it painstakingly obvious when your investor undertakes the investment, all the risks that are involved. Now, that doesn't mean that you can't promote your business both in the document and in supplemental materials, whether it's an investment deck or a business plan. You can tell them about the upside. Just tell this group about the downside as well, and that will save you a fortune down the line.